investing has become a larger and larger part of the overall U.S. ETF marketplace. How does it work, and what ways might it enhance your investment portfolio's design? Here to help us sort through it is Holly Framsted, Head of Factor Investing within BlackRock's ETF Group. Holly, welcome to ETF Guide TV.
Thank you so much. I'm happy to be here.
Let's begin with these questions. What is factor investing, and how does it work?
Factor investing is a style of investing that harnesses well-researched, often very widely understood investment philosophies. So these are things like investing in stocks that are underpriced or delivering value in a portfolio, or investing in companies with stronger balance sheets or more stable earnings. This is quality investment. Factor investing rhymes with active management of prior decades because it's harnessing many of the same insights, but it's delivering those insights within the portfolio in a very systematic framework, and as a result, can often deliver the investment outcome at a far lower price point.
The assets in factor-linked ETFs has experienced steady growth. How much does it represent within the overall U.S. ETF market, and why has it grown in popularity?
Factor ETFs have experienced exponential growth. You're absolutely right. And I think an easy way to remember the size of the overall ETF market is that as of 4/30, it represented about 10% of total ETF assets, or roughly $430 billion, just south of that. Factor investments have become part of the mainstream because they're delivering on active insights at a very low price point. And as a result, they're becoming very mainstream as investors are thinking about them as valuable tools for delivering tax-efficient returns within a portfolio.
Among the many different types of factor investing that exist, there's the Big Five, which cover various styles, strategies, and philosophies. Can you tell us more about the Big Five?
The Big Five represent the 5 factors that are universally viewed as rewarded in the market, meaning when captured, they're giving you better risk-adjusted returns than an alternative. Those Big Five represent quality, which is investing in companies with strong balance sheets and stable earnings. QUAL is the iShares ticker that corresponds to that factor. Value, VLUE, which represents companies that are underpriced relative to their fundamentals. Momentum, or MTUM, which represents companies that are trending in the market. Size, or smaller cap investments. And then finally, minimum volatility, and USMV is the largest ticker in the space for that factor.
Great. BlackRock offers single factor ETFs along with multi-factor ETFs. How are investors and financial advisors using these types of funds inside their portfolios?
The most critical part of factor investing is to recognize that it is important to be diversified at all times. So investing in concepts like value alongside momentum can bring diversification in a portfolio because they're harnessing different drivers of return, which are complementary to one another. And so when we think about building a portfolio, it's important to have exposure to multiple factors. For some investors, multi-factor funds like LRGF as a U.S. exposed ticker represent a single ticker solution or a one-stop shop solution for diversification across multiple of these drivers of return. But factors express cyclicality. So at certain stages of the economic cycle, some factors are favored over another. And single factor investments offer the portfolio constructor or the investor who wants to express a view really valuable tools for achieving diversification across multiple funds, but fine-tuning how much exposure they have to each based on the view they want to express in the market.
One final question for you. What's your overall outlook for factor investing?
Factor investing is incumbent in many cases upon where we head in the economic cycle. So if we think about where we're at right now, BlackRock believes we're firmly in a contraction, and we probably will be for some time, at least through another quarter. In the contractionary phase of the economic cycle, we tend to favor investments that bring greater resilience in the portfolio. So quality and minimum volatility as mechanisms for reducing risk can be incredibly powerful tools, particularly to limit the downside in the event of low overall market growth. As we begin to head out of a contraction, though, because contractions are oftentimes over the long run quite short, then we want to start thinking about the investments that will be favored moving forward. And depending upon the shape of the recovery, value and small cap investments can be incredibly powerful tools to capture a swift uptick in economic activity. Or if you believe that the recovery is going to be far slower, then certainly maintaining resilience through quality and minimum volatility can be incredibly powerful ways to play that recovery as well. So right now we position for defensiveness, but oftentimes we're talking with clients about what the next move will likely be when we start to see green shoots of a recovery.
Great. Holly, we appreciate your insights and having you drop by today. Again, you just heard from Holly Framsted, head of factor investing within BlackRock's ETF group. I'm Julie Gaertner with ETF Guide TV. Thanks for watching.